Good afternoon, ladies and gentlemen, and we welcome you to our presentation where we are looking at the financial analysis of Blantyre Hotels Limited. We are a group of 4 presenters. There's Mlezi, Sitembile, Matfale, and myself, Messi. So this is our presentation outline. We'll take you through the introduction, and then we'll look at the background of Blantyre Hotels Limited. We'll also look at the techniques that we employ to do this analysis and looking at the ratios, that's profitability, efficiency, liquidity, and gearing. And of course, we'll also take you through the conclusion and our recommendations to the analysis. So just to share with you some literature about financial performance, it's very crucial that stakeholders should do financial performance of their respective companies because it helps to look at the operational efficiency of a company and its future prospects. But also it aids in decision making and performance evaluation. And it also guides on issues of budgeting and forecasting because you are able to understand how the company is performing. So it's important that companies have to carry out a financial performance analysis so that they can also be compliant to issues of taxation assessments. So just like I have highlighted in my previous slide, analysis of financial report can also help business managers, investors, lenders, and other stakeholders in terms of decision making, but also looking at financial position of a business. So we'll take you through the background of Blantyre Hotels Limited before we actually go into the actual analysis. Blantyre Hotels Limited, it's a holding company. It operates a hospitality and tourism industry here in Malawi. And it owns the Rios Hotel, which is based in Blantyre. And it's also managed by Protea Hotels, which is owned by Marriott and based in South Africa. This company was incorporated in 1965 and listed on the Malawi Stock Exchange in 1997. So currently it's trying to expand because it's also constructing a new hotel in Lilongwe, which is expected to end in 2025. Let me hand you over to my colleague to proceed with the presentation.
The techniques that will be used in this presentation includes horizontal analysis, because we are comparing 2 different periods, but we also use the 4 ratios that are listed below. These are the detailed visualization of the ratios that will be used in this presentation. Just as we have said, profitability in this presentation will measure the profitability on how the business is conducting its operations and sales, but there's been a loss in the 2 years that we were analyzing, and that is due to the high cost of sales and selling and admin costs. And there has been also a persistence return on capital employed, a negative. This doesn't look good to the investors. And this is mostly because the core operations of the business are not profitable. On return on equity, the business also registered decline between the years under review. These are the formulas that we used in this particular presentation. This one is a visual presentation on profitability from the ratios that we have used. And as you can see, there's been an improvement on gross profit for the 2 periods on gross profit and asset turnover. But for the 3 ratios, that is return on capital employed, net profit, and return on equity. For the solutions that we are proposing to BHR, simply because we have said that the admin costs have been high during the period. Control of those costs are very, very necessary in order to achieve profitability. But it should also reduce overhead costs, and it should also have some strategies to ensure that revenues are increased. It's also very, very important to adopt aggressive marketing strategies, which should include the introduction of new services or revision of prices. This will contribute to increase in their revenues. Again, the firm should look into their supplies and, if possible, negotiate on good terms. These terms should discuss on the costs that it gets its goods and services. And finally, there should be an effective asset management, simply because currently, from the look of things, there has been heavy underutilization on fixed assets. From there, I do now hand over to my colleague Mlezi to further present on liquidity and gearing. Thank you.
I think I'll present on efficiency. So efficiency is the firm's ability to utilize current and fixed assets effectively so that they can maximize in terms of output. So basically, efficiency looks into how quick a business converts its current assets into cash. Efficiency also would help the company in terms of managing resources. But if you have higher efficiency ratios, then nothing can help in terms of enhancing the investors' confidence. So these are the ratios which we had used in terms of when we were assessing Blantyre Hotels Limited. They'll be explained more in the next coming slides. This is also there's the visuals as well. The next slides will explain more. This is also a visual just showing in terms of data's collection period and also creditors repayment period. So in terms of inventory turnover, Blantyre Hotels registered 5.4 in 2023 and 3.9 in 2022. In terms of inventory for non-perishable, it was 3.9. This is reasonable as opposed to perishable. So what we're saying that if 3.9 was to do with non-perishable goods, then that was okay. But if it is perishable, then I think the company should improve on that because this is not good. So in terms of efficiency, we also looked at debtors payment and also creditors payment days. As you can see that it was taking 42 days in FY22 and 37 days in FY23. And in terms of creditors, it was taking 85 days in FY22 and 139 days in FY23. The longer the business takes to pay its debtors, it's better because it helps to improve its liquidity. That's according to Headline 2018. However, this was not the case with the company which we're studying. As you can see that the days, I think, were high, 185 in FY22 and 139 in FY23. In terms of cash conversion, the cash conversion cycle was 41.68 in FY22 and 36.68 in FY23. The increase in FY23 was to do with the acquisition of new assets. So the company had acquired new assets. That's why there was that increase. In terms of solutions, the company can improve its efficiency by disposing of fixed assets, maximizing occupancy rates of their rooms, and also in terms of maximizing the occupancy of their room, they can do this by improving in terms of marketing strategy, training their staff, and also improving on quality assurance. But it was one of the areas which might be making the hotel not to be fully booked as the other hotels within the vicinity they are doing. Thank you. Now I'll hand over to my colleague, Mlezi. This should be the last slide.
All right. We also assessed and analyzed BHL financial performance using the liquidity ratios just to try to understand their liquidity. And we used the current ratio as well as the acid test ratio for the 2 years. And what we noted was that their liquidity was very low. For example, in the FY 2023, the liquidity was 0.33 to 1, whilst in FY 2022, it was 0.441, and then in FY 2023, the liquidity went down further to 0.331, meaning that for every 1 kwacha liability, they only had 33 tambala and 44 tambala for the 2 years to meet their daily obligations in essence. And this could also mean that the investors might not have confidence in the business, considering the liquidity and the state of it as it is now. This could be attributed to the short-term debt that they have, which is pretty much very high, and that also affects the cash flow of the business. So on liquidity ratios, like I indicated earlier on, we did the acid test ratio and the current ratio. We touched a little bit on the operating cash ratio just to understand how quick the business is able to to turn their current assets into cash. So like I indicated earlier on, you can see that there was a further decrease in the current ratio from FY 2022 to FY 2023, likewise with the asset test ratio, further indicating how bad things are in terms of liquidity. So in essence, what it means is that the business is having challenges to maintain the liquidity of the business. For example, you can see that in the 2 years, their levels was still low. There hasn't been any much improvement. And maybe this could be because every cash that is coming in, it's going to finance the debt. So just in summary, we could see that for the business to improve its liquidity, there are a couple of things that they need to do, and that is to work around their working capital. They also need to look into their current liabilities and try to find ways of how they can reduce the current liabilities, but also consider maybe inventory levels to say, okay, what can they do to manage their inventory, and maybe also dispose of some assets that maybe they're not in use, or maybe they're being underutilized, so that they can bring back the money into the business. Next slide, please. So I'm going to present on the gearing ratios that we also calculated, just to understand further how the business is faring, particularly when it comes to financing of the business. We all understand that businesses are financed by either long-term debt or short-term debt. So what we wanted to find out was also to analyze or to assess how the business is financed. So we use all those ratios, as you can see. Next slide, please. So because gearing ratios, they normally measure how the business is performed, that's why we found it very imperative to try to understand the situation of the business using the gearing ratios. And what we noted is that high gearing ratios usually indicate a higher financial leverage, which means if a business is highly geared, it means it's so much dependent on long-term debt, or it could be short-term debt in general. So what we noted for BHL is that it is highly indebted, and because of that, that can affect its future prospects, because it means even to have investors to come in such kind of a business that has those operating prospects, there's a challenge, because now investors will not be so sure of their investment in the business. And then also we are looking at how maybe the business can also address some of these challenges that they are facing in terms of their gearing. Next slide, please.
Team, just to note that you have 2 minutes left.
Right, thank you. So in essence, those are the ratios that we calculated. I'll not go further into that because they're self-explanatory. Next slide, please. Right, so for the business to improve on their gearing ratio, I think some of these things have already been mentioned in the other presentation that was done by my colleagues. So we are looking at maybe additional things that the business can do is to maybe issuing additional capital to strengthen their capital base by issuing maybe new shares. We are also maybe looking at how they can do asset management. Maybe if there are some assets that are being underutilized, they can think of maybe disposing them of. But we have also seen a strategic move that they have taken by partnering with Marriott Hotel, where now they can share the burden on the debt that they have. Yeah, so maybe they could also, looking at their balance sheet, you notice that they have a very high amount of short-term debt. They would also maybe explore ways of how they can convert that to long-term debt. I'll continue with the conclusion, or maybe I'll bring in my colleague who is going to do the conclusion, and I'll come in again with the recommendation. Thank you.
Yeah, of course, I would have said, Mlezi, you can just finish on that. But maybe just to add that this company, we've noted that it has weaknesses and strengths according to the ratios that we did. And also, because the picture is not good, they can continue to lose the confidence of investors, and they can even go into bankruptcy. So I think, Mlezi, you can just finalize on the recommendations that we came up with for the company to improve. Thank you.
Thank you, Mercy. Next slide, please. So in terms of recommendations, we recommend that the business work on their selling and administration cost. They need to reduce those. For example, maybe their overhead costs. It could be maybe they have many employees. It could be other administrative costs. It could be maybe some fees that they pay and all that. They could also maybe look into their marketing strategies and maybe indulge themselves in aggressive marketing strategies to meet the competition so that they can drive traffic to the hotel. And they can also maybe look into asset management, like our area alluded to, and maybe they can also staff training. They could maybe consider training their staff in different aspects so that they attract customers to the business. So some of the other recommendations that we made are recommendations that we have already made when we are doing the presentation. At this point, let me thank you all for your attention, and I open the floor in case maybe there are any questions. Thank you.
Thanks, team, for that great presentation. I think it was quite clear, but I just have one question. So you've made a recommendation on the company reviewing their pricing structure. Just to hear from you in terms of what is the role of price in the company's profitability? And then I'll check if anyone else has another question so that you can just take them both at once. Yes, Francis, you have your hand up. Go ahead.
Yeah, thank you, Chair, and many thanks to the team for the presentation. Just a quick question, more especially on the performance of the year 2023, whereby there's a net loss. In your opinion or in your analysis, what do you think might have contributed to the net loss during the year? Thank you.
Thank you for those questions, Francis and Singer. So due to time, I will limit my responses, but we can continue the debate in the chat. So first of all, I will answer on price. Price, if the hotel can use price for profitability, if it increases its price, then it can automatically increase its revenue. That is assuming that all of its clients will still be with the firm. And again, even if it can also reduce, then it can also manage to attract some other clients. But we do know that this particular firm has got competitors. So if it increases its price, then some of the clients might be lost to the competition. So price should be treated with caution. On the major contributing factor for the net loss, in our analysis, we noted that it was mostly due to the selling and administrative costs, which were higher during the year. So despite the fact that it had more revenues than the previous year, but this were also higher, about 40% from the previous year. So this one contributed with the depreciation that happened during the year. It's what mostly contributed to the net losses. Thank you.
All right, thanks, team. If no one else has any questions, I think we'll end the presentation there, but thank you for that great presentation.